Okay, let's unpack this. We spent a lot of time looking at how evidence gets gathered, testing controls, confirming balances, all that groundwork.
Right, the detail testing phase.
Exactly. But for anyone serious about mastering the ACCA syllabus and really stepping into practice, the real pressure point comes right at the finish line, the final verdict.
hmm The reporting stage.
So this deep dive is for you, the learner. We're focusing squarely on getting that audit review and reporting stage nailed down. This
Right.
is where all that, technical effort turns into the final public opinion.
It really is the culmination, isn't it? You shift gears here. You go from being like a super focused investigator looking at details
Yeah.
to being a communicator,
Yeah.
telling the world about the level of certainty or maybe uncertainty in those financial statements.
So our mission today is basically to pull together all those critical ideas around the wrap-up. We're talking subsequent events, applying standards to those tricky contingent items,
The probabilities.
getting those final management sign-offs, the written reps, and crucially understanding how to actually structure the auditor's report. That takes some serious professional judgment under the ISAs.
Absolutely. And the goal isn't just ticking boxes. It's about building real confidence, real clarity, especially for when you face those exam questions about, say, modifying the report or judging materiality or figuring out if something's pervasive.
Because let's face it, this stage, it pretty much determines how credible the whole audit is
Mhm.
and whether those financial statements are actually useful for the people reading them. We're digging right into the ISA requirements here, the rule book for drawing conclusions and communicating them properly. It's the ultimate test, really.
And it's helpful to frame this final review stage.
Mhm.
It's where the auditor's perspective broadens. You're not just looking back at transactions that happened during the year.
Right.
You're making sure the financial statements reflect the reality at the reporting date, but you also have to factor in significant things that happen after that date, plus all those inherent uncertainties swirling around things like lawsuits, or even whether the company can keep trading.
And you mentioned earlier that final decision, the actual opinion in the report, it boils down to how the auditor handles essentially two big types of problems they might find.
Exactly. It simplifies things quite a bit, actually. Every major issue you hit during the final review falls into one of two camps.
Yeah.
Camp 1. The financial statements are materially misstated.
Okay, so disagreement. You think they're wrong.
Precisely. The numbers, the way they're presented, the disclosures, something doesn't align with the accounting rules like IFRS, or it's just factually incorrect.
And the second camp?
Camp 2. Inability to obtain sufficient appropriate audit evidence. We usually call this a scope limitation.
Meaning you couldn't check if they were right or wrong.
Exactly. Maybe management blocked access. Maybe records were destroyed. Maybe you just couldn't perform a critical procedure. You lack the proof.
Okay, misstatement versus lack of evidence.
And understanding how the size of the issue materiality and how widespread it is, pervasiveness interacts with these two problems. Well, that's the key to unlocking the 4 possible opinions we're going to cover.
Got it. That's the framework. Let's dive into the first big area then, that time gap. Right, ISA 560. That period after the balance sheet date, say December 31st, but before you actually sign off on the audit report, maybe in March. It feels like a bit of a danger zone.
It is a critical period. Think of the financial statements as that snapshot on December 31st. But things keep happening in January, February.
The world doesn't stop.
Exactly. And ISA 560 sets out very specific responsibilities for the auditor during this window. And crucially, those responsibilities change depending on whether you've signed the report yet.
Okay, so break that down. What's the deal before signing?
Before the report is signed, the auditor has an active duty. You are actively required, mandated by the standard, to perform procedures specifically designed to find any events that occurred after the reporting date that might need adjusting in the accounts or disclosing in the notes.
Active duty. So you can't just sit back and wait for management to tell you something happened. You have to go looking.
Precisely. You have to be proactive. And this is often tested, the application. It's not passive listening, it's active seeking.
Okay, so what kind of active seeking are we talking about? What are the actual procedures an auditor needs to do during this time?
Good question. It involves things like first looking at the latest management accounts, comparing January and February's results to expectations, any weird dips or spikes.
Could signal something major.
Second, reading the minutes of board meetings, any key committee meetings held after year-end. Decisions get made there. Refinancing, restructuring.
Right, strategic stuff.
Third, reviewing cash movements after year-end. Any large receipts settling old debts. Big unexpected payments.
could relate back to year-end balances. Okay.
Fourth, direct inquiry. Asking management, and those in charge of governance specifically, has anything significant happened since December 31st that we need to know about?
Gotta ask the direct question.
Fifth, checking in with the company's lawyers again. Any updates on those legal cases we talked about? New ones popped up?
Links to contingencies, yeah.
And sixth, reviewing any updated cash flow forecasts, especially if there were going concern worries. Are their plans still looking feasible?
That seems pretty comprehensive. It's a focused burst of activity right before you sign.
It has to be. You need that final sweep.
Okay, so that's the active duty before signing. What happens after the report is signed, and maybe the accounts have even gone out to shareholders? Are you off the hook then?
Mostly, yes. The duty changes. After signing, it becomes a passive duty. You're no longer required to perform any procedures to look for events.
Ah, okay, so you can relax.
Well, not entirely. If a significant fact comes to your attention after the report has been issued, maybe you read it in the news, or the regulator calls, or even management tells you, and crucially, if you had known about it before signing, it would have caused you to amend the report.
Then you still have to do something.
Yes, you can't just ignore it. Your responsibility then is to discuss it with management, with the directors.
And what if they agree it's serious?
If they agree the financial statements need amending because this new information is material, then they are responsible for reissuing amended financial statements. Your role as auditor is then to audit those specific amendments and issue a new revised audit report explaining the situation.
Okay, so there's a mechanism, but the onus shifts back to management first.
Correct. But failing to act if you become aware of something major carries huge risks, reputationally and legally.
Makes sense. Now, within this period, events aren't all treated the same way, right? There's this key distinction auditors have to make.
Absolutely critical distinction. This determines the accounting treatment. We split them into adjusting events and non-adjusting events.
Let's start with adjusting events. What are they?
Adjusting events provide evidence, near evidence, about conditions that already existed at the reporting date at December 31st. They essentially confirm or clarify the situation as it was back then.
Okay, you mentioned a customer going bust in January. Why is that adjusting? The bankruptcy happened after December 31st.
Right. The formal bankruptcy filing might be in January or February. But let's say this major customer owed you £5 million at year-end. Their collapse in January strongly suggests they were already in deep financial trouble back in December. The inability to pay existed at year-end.
Ah, I see. The bankruptcy is just the final confirmation of a pre-existing problem.
Precisely. So the financial statements for the year ended December 31st need to be adjusted to reflect that reality. You'd need to make a provision against that receivable or write it off. It affects the valuation assertion at year-end.
So adjusting events often relate to confirming estimates or valuations that were uncertain at year-end.
That's a very common trigger. Another classic example. Inventory valued at cost at December 31st is sold for significantly less than cost in January. That sale provides evidence that the net realizable value, the NRV, was actually lower than cost back in December. So you adjust the inventory value downwards in the December 31st accounts.
Okay, that makes sense. It's correcting the picture at year-end. What about the other type, non-adjusting events?
These relate to conditions that arose entirely after the reporting date. The situation was fine on December 31st. Something new happened afterwards.
Like the factory burning down example.
Perfect example. If the factory burns down in mid-January, well, on December 31st, it was a perfectly good, correctly valued asset on the balance sheet. The fire created a new situation.
So because the December 31st balance sheet was accurate at the time, you don't go back and change the asset value for that year.
Correct. No adjustment to the primary financial statements. The balance sheet, the income statement is needed for a non-adjusting event.
But surely users need to know about it. A factory burning down is pretty major.
Absolutely. And that's the requirement. For significant non-adjusting events, disclosure is mandatory in the notes to the financial statements. You need to describe the event and estimate its financial effect, if possible.
Why disclosure?
Because even though it doesn't affect the past year's figures directly, it's fundamental information for users trying to understand the company's future prospects and financial position going forward. Losing a major factory impacts future production, revenue, everything.
And if management doesn't disclose a significant non-adjusting event?
Then that omission itself becomes a material misstatement in the financial statements. The statements are misleading because they lack crucial information, and that takes us back towards potentially modifying the audit opinion.
Okay, so adjust if the condition existed at year-end, Disclose if it arose after but is significant. Got it. Hashtag 1.2. Dealing with uncertain outcomes. Contingencies. Right, now let's move on to something that often feels a bit fuzzier: contingencies. We're talking about IAS 37 here. Situations where the outcome is uncertain, maybe a lawsuit, maybe an insurance claim, and the key, you said, is it must stem from a past event.
Exactly. You can't have a contingency for something that might happen in the future but hasn't been triggered yet. It has to relate back to something that already occurred. And the accounting treatment under IAS 37 is very strict, driven by prudence and based entirely on the probability of resources flowing in or out.
Prudence, the idea of being cautious, right?
Yeah.
Not counting your chickens before they hatch.
Pretty much, especially when it comes to recognizing gains. But let's tackle the potential bad news first. Contingent liabilities. We're looking at situations where there's an obligation from a past event that might lead to an outflow of resources, like paying damages in a lawsuit.
How do we decide the treatment? You mentioned probability.
It's a three-tier test based on likelihood.
Is the outflow probable? This generally means more likely than not, say over 50% chance. Although in practice, auditors often look for a bit more certainty, maybe 70% plus. If it's probable, and you can estimate the amount reliably, then you must recognize a provision.
A provision. So it hits the books.
Yes. It's a liability on the balance sheet and an expense in the income statement. Debit expense, credit liability, you recognize the expected cost now.
So if the company's lawyers say, look, based on similar cases, we're almost certainly going to lose this lawsuit from last year, you can't just wait and see.
Nope. If it's probable and estimable, the provision has to go in. Not doing so means liabilities are understated, profit is overstated. That's a material misstatement.
Okay, what if it's less likely? Not probable, but maybe not impossible either.
That's the second tier. Possible. The outflow is less likely than probable, but it's more than a remote chance. Here, prudence says you don't recognize a provision, the certainty isn't high enough. Instead, you provide detailed disclosure in the notes.
So you tell users about the risk, but it doesn't hit the main numbers.
Exactly. The disclosure needs to explain the nature of the contingency, give an estimate of the potential financial impact if possible, outline the uncertainties, and mention if any reimbursement is expected, say from insurance.
And a third tier, if it's really unlikely.
That's remote. If the chance of an outflow is very slight, maybe less than 5%, then you do nothing. No provision, no disclosure, no need to clutter the accounts with highly unlikely scenarios.
Makes sense. Now, assessing that probability, probable, possible, remote sounds subjective. Management might be, shall we say, optimistic. How does the auditor verify this?
Great question. We can't just take management's word for it. We need objective evidence. The number one procedure here is reviewing correspondence with the company's external legal counsel. We often send a specific legal inquiry letter asking for their professional opinion on the likely outcome and potential costs of any litigation.
So you rely on the lawyer's independent view.
Heavily. We also look at board minutes. How are they discussing it internally? Are there settlement offers on the table? We compare the lawyer's view to management's assessment. If the lawyer says probable loss and management hasn't provided, we have a problem. We push for the provision.
Okay, that covers potential outflows. What about the flip side? Potential inflows, contingent assets, things like an insurance claim the company is pursuing, or maybe a countersuit.
Right. And here, prudence bites even harder. The rules for recognizing potential gains are much stricter.
Stricter how?
We use similar probability terms, but the thresholds for action are way higher. Let's start at the top. If an inflow is virtually certain, meaning it's almost guaranteed, maybe the court has ruled in your favor and the appeal period is over, the cash is basically on its way.
Then it's not really contingent anymore.
Exactly. It's not contingent. You recognize it as a proper asset on the balance sheet. It's happened.
Okay, but what if it's only probable? Remember, a probable outflow needed a provision. What about a probable inflow?
This is the key asymmetry. If an inflow is only probable, more likely than not, but short of virtually certain, you do not recognize an asset. Prudence forbids it.
Wow. So even if it's likely you'll win that insurance claim, you can't book it as income yet.
Correct. Instead, you provide disclosure in the notes explaining the situation. You tell users about the potential gain, but you don't let it inflate the assets or profits until it's essentially locked down.
Why the difference?
To prevent companies from overstating their performance by recognizing income that might not actually materialize, liabilities are recognized sooner, assets are recognized later. That's prudence in action.
And if the inflow is not probable, less than a 50% chance.
Then you do nothing. No asset recognition, no disclosure.
So just to summarize that difference, Probable outflow. Provision hits the numbers.
Mhm.
Probable inflow. Disclosure only in the notes.
You've got it. It's a deliberate bias towards caution, and the auditor's job is to make sure the company follows it. It protects users from overly optimistic accounting.
Okay, we've looked at timing with subsequent events. We've handled uncertainty with contingencies. Now we get to ISA 580, the written representations letter. This feels like the final formal handshake, getting management to put their key assertions down on paper.
It is a crucial piece of audit evidence, absolutely. It's a formal document, usually a letter addressed to the auditor, signed by management, typically the CEO and CFO. Its main purpose is to get management to explicitly acknowledge their fundamental responsibilities.
Like what specifically?
Primarily, their responsibility for preparing the financial statements in line with the accounting framework, like IFRS, and for designing and implementing internal controls to prevent misstatement. It also confirms they've given the auditor everything, all information, all records, access to people.
So it's about confirming their role and that they haven't hidden anything.
That's a big part of it. Getting it in writing reduces misunderstandings and gives the auditor documented confirmation of these key management assertions.
And I feel like this is a really important but. For exam purposes, these representations have a major limitation, don't they?
Huge E limitation. And yes, frequently misunderstood or tested, ISA 580 is crystal clear. Written representations do not provide sufficient appropriate audit evidence on their own for any matter they cover. Meaning, you can't use a management rep as a substitute for performing other necessary audit procedures. Management telling you in the letter that all related party transactions have been disclosed does not replace the auditor's own procedures to identify and test related party transactions.
Right. So if you couldn't, say, attend the inventory count because they wouldn't let you, getting them to write the inventory quantity is correct in the rep letter doesn't fix the problem. It's still a scope limitation.
Absolutely. The rep letter provides supporting evidence. It corroborates other evidence, especially regarding management's intentions or judgments. But it's not primary evidence for existence or valuation or completeness if other evidence should be available.
So useful, even essential, but not a magic bullet to cover gaps in other evidence.
So precisely. Think of it as reinforcing, not replacing.
Okay, let's get specific then. What are the core mandatory representations that management must provide in every audit?
There are a few non-negotiables that go to the heart of their duties.
They have fulfilled their responsibility for the preparation and fair presentation of the financial statements according to the applicable framework. That's fundamental.
Acknowledging ownership.
2, they acknowledge their responsibility for designing, implementing, and maintaining internal control relevant to preparing fair statements.
Owning the system.
And 3, they confirm they have provided the auditor with all relevant information and access as agreed in the engagement terms, and that all transactions have been recorded and reflected in the financial statements.
That third one feels particularly powerful. It's a direct assertion about completeness.
It is, because if you later find out they deliberately hid something material, a secret bank account, an unrecorded liability, that written representation becomes evidence of management potentially misleading the auditor, which has serious consequences.
We'll definitely get to those consequences. Hashtag tag 2.2 subject matter specific representations. Beyond those core responsibilities, are there specific areas where the standards say you must get a written rep? Things where maybe management's intent or knowledge is particularly key?
Yes, absolutely. This is where representations become especially valuable, addressing things that are hard to audit just by looking at documents or assets. The ISA specifically requires reps in several areas, and auditors often add others based on the engagement's risks.
What are some common examples from the standard?
Okay, key ones include fraud. Management needs to confirm they've disclosed to the auditor their assessment of fraud risk and any actual suspected or alleged fraud they're aware of involving management, key employees, or others. That links directly to ISA 240.
Makes sense. You need their input on that.
Laws and regulations. Similar to fraud, they need to confirm they've disclosed all known instances of noncompliance or suspected noncompliance, litigation, and claims. They must confirm that all known actual or possible litigation and claims have been accounted for and disclosed according to the framework linking back to ISS 37 and our contingencies discussion.
Right, corroborating the legal letters.
Related parties. Confirmation that they've disclosed the identity of related parties and all related party relationships and transactions. Again, completeness is key here. Subsequent events. Confirmation that all events occurring after the reporting date that require adjustment or disclosure have been appropriately dealt with. ties back to ISA 560.
Okay, lots of confirming disclosures. What about areas involving significant judgment or future plans?
That's a big one, especially concerning going concern under ISA 570. If there are potential threats to the company's ability to continue operating, management must provide representations confirming their plans for future actions intended to mitigate those threats, and their assessment of the feasibility of those plans.
So, if the company's facing losses, they might represent that they plan to secure new funding or sell off an unprofitable division.
Exactly, but remember our limitation point. Getting that representation isn't enough.
Right, you can't just take their word that they plan to do something. How do you audit that intention?
You have to corroborate it. As the auditor, you need to evaluate the feasibility and likelihood of those plans succeeding. You look at their detailed cash flow forecasts. Are the assumptions reasonable? Do they show a path back to stability? Evidence of mitigating actions. If they plan to sell assets, are there actual offers? If they plan to get a loan, is there a draft agreement from the bank? Letters of support from parent companies? Management's track record? Have they successfully implemented similar plans before? Or do they have a history of failing to deliver? External consistency. Are their plans for, say, revenue growth realistic given the market conditions?
So the representation letter documents their stated intent, but the real audit work is testing whether that intent is credible and achievable based on other evidence.
Perfectly put. The rep is the starting point for auditing subjective areas like intent, not the end point. Hashtag tag 2.3 consequences of refusal or inconsistency.
Okay, this brings us to the crunch point. What happens if things go wrong with the reps? Say management just flat out refuses to provide a representation the auditor believes is necessary. Or maybe they provide one, but it directly contradicts other strong evidence you've found.
This is a serious breakdown in the audit process and raises immediate red flags about management's integrity.
Red flags how? What's the first step?
The first step, required by the standard, is the auditor must reevaluate management's integrity and competence. If they're unwilling to provide necessary confirmations, or if they provide information that contradicts other evidence, how reliable is anything else they've told you? Oral statements, other documents they provided throughout the audit.
The doubt becomes pervasive. It taints everything.
Exactly. You have to reconsider the reliability of all management assertions and evidence. You also need to discuss the matter with those charged with governance, the audit committee, or the board, unless they are the ones involved in the refusal.
Okay, so you reassess integrity, you discuss it upstairs. What's the impact on the audit report itself?
It depends on which representation is refused or contradicted and how significant it is. The most severe case. If management refuses to provide those mandatory core representations we discussed, like acknowledging responsibility for the financial statements or confirming they provided all information.
The really fundamental ones.
Yes. If they refuse those, the auditor concludes they haven't obtained sufficient appropriate evidence about basic pervasive matters. The foundation of the audit is compromised.
And when you have a pervasive scope limitation imposed by management.
The required outcome is a disclaimer of opinion. The auditor states they cannot form an opinion on the financial statements because of the significance of the missing confirmations about management's fundamental responsibilities. It effectively halts the audit opinion.
Wow, a disclaimer just for refusing to sign the standard letter.
If it's those core foundational responsibilities, yes. Because without that acknowledgement, the whole premise of the audit is undermined.
What if the refusal is about a more specific matter? Say they sign the core reps, but they refuse to provide a specific representation about the completeness of litigation, even though your other evidence suggests there might be an undisclosed claim.
Okay, in that case, the auditor has to consider the impact of that specific scope limitation, or if the contradiction points to a misstatement. If the auditor, through other procedures, believes there is an undisclosed material liability, a misstatement, and management refuses to acknowledge or fix it, that leads towards a modified opinion based on the misstatement.
So maybe a qualified opinion if it's material but not pervasive?
Likely, yes. A qualified opinion stating, except for the effects of the unrecorded liability. If, however, the auditor simply cannot get enough evidence about the potential claim, because of the refusal, a scope limitation, and the potential effect could be material but not pervasive, it would be a qualified opinion except for the possible effects of the limitation.
And if the potential impact of that specific refusal is considered pervasive?
If the lack of evidence on that specific point is so significant it affects the understanding of the financial statements as a whole, it could still escalate to a disclaimer. Or, if the contradiction clearly indicates a pervasive misstatement, like hiding massive liabilities, it could lead to an adverse opinion. The key is always materiality and pervasiveness of the specific issue.
So, refusing or contradicting reps is a major warning sign with potentially severe reporting consequences, right? We've done the subsequent event checks, wrestled with contingencies, got the management reps hopefully signed off. Now it all comes together in the final product, the auditor's report. This is the communication to the users, and it needs to be absolutely precise following the ISA reporting standards.
It does. And before we even get into the modifications, the qualified, adverse, disclaimer opinions, it's crucial for students to have the structure of the standard, clean, unmodified report locked down. ISA 700 lays this out because modifications are essentially changes to this standard structure.
Okay, good point. Let's assume everything was fine. No material misstatements, no scope limitations found, or they were all corrected. What does that standard, unmodified, clean report look like? What are the key sections?
It follows a very specific mandatory order designed to be clear and manage expectations. The key elements are: 1. Title. Clearly states it's an independent auditor's report. 2. Addressee, usually the shareholders or members of the company. 3. Opinion section. This is right up front, the main message. It states the auditor's conclusion typically that the financial statements present fairly in all material respects or give a true and fair view, depending on the jurisdiction and framework. It identifies what was audited, the specific statements and dates.
The verdict first thing.
Exactly. Then immediately after. 4. Basis for opinion. This section states the audit was done according to international standards on auditing, ISAs. It confirms the auditor is independent and met ethical requirements. And critically, it includes a statement that the auditor believes the evidence obtained is sufficient and appropriate to provide a basis for the opinion.
Basically saying, here's our opinion and here's why we're qualified to give it.
Precisely. Then comes 5. Going concern. Usually a brief mention if there are no material uncertainties. If there's a material uncertainty that has been disclosed, we handle it with a specific paragraph later, but this section might cross-refer. 6. Key audit matters. CAMs. This is a big one, especially for listed entities where it's mandatory. We'll circle back to this.
Okay.
7. Other information. Deals with information published alongside the FS, like the director's report or chairman's statement. The auditor states the responsibility regarding this. 8. Responsibilities of management and superintendents, those charged with governance for the financial statements. Spells out clearly that management is responsible for preparing the accounts correctly, for internal controls, and for assessing going concern.
Defining their role.
9. Auditor's responsibilities for the audit of the financial statements. This is usually the longest section. It explains the objectives of an audit. Reasonable assurance, free from material misstatement. Describes what an audit involves. Procedures, risk assessment, testing controls, evaluating estimates and disclosures, and crucially, highlights the inherent limitations of an audit. It's not a guarantee. Fraud can be hard to detect.
Managing expectations about what an audit can and can't do.
Finally, you have the engagement partner's name for listed entities in many jurisdictions, the auditor's signature, the auditor's address, and the date the report is signed.
That date is key, right? It links back to our subsequent events discussion, the end of the active duty period.
Exactly. That date marks the point up to which the auditor performed active procedures.
Okay, you mentioned key audit matters, conjurams, being mandatory for listed companies under ISA 701. Let's dig into that. What exactly goes in this section? It sounds important.
It is important. It's designed to make the audit report more informative for users by highlighting the areas that cause the auditor the most significant challenge or require the most significant judgment during the audit.
So it's not just repeating what's in the notes.
No, definitely not. CAMs are selected from matters communicated with those charged with governance. They're typically areas of higher assessed risk of material misstatement, areas involving significant management judgment, like complex valuations, impairment tests, provisions, or the audit impact of significant events or transactions during the year, like a major acquisition.
So for each CAM identified, what does the auditor have to describe?
For each CAM, the report must explain why the matter was considered one of the most significant, why it was key, and then summarize how the auditor addressed the matter in the audit. What were the key procedures performed to get comfortable with that area?
So it gives users insight into the audit itself, where the focus was, what the tricky bits were.
Precisely. It enhances transparency. For example, if valuing an intangible brand was complex, the CAM section would explain why it was complex. For example, reliance on forecasts, and outline the audit steps, challenging assumptions, using auditors' experts, checking calculations.
And you mentioned a critical link to the type of opinion earlier.
Yes, absolutely critical point. If the auditor issues a disclaimer of opinion, they must not include a key audit matters section.
Why not?
Because if you couldn't gather enough evidence to form any opinion on the financial statements as a whole, you logically cannot describe the most significant matters you audited. The basis for identifying CAMs has collapsed, along with the ability to issue an opinion. Hashtag 3.1, the modification framework.
Okay, standard report structure and CAMs covered. Now let's get into the modifications. This happens when things aren't clean. You said it boils down to those two main problems, misstatement or scope limitation.
That's right. The decision to modify the opinion starts with identifying which of those two buckets the problem falls into. Let's revisit them with a bit more focus on the judgment involved.
Financial statements are materially misstated. This is a disagreement. The auditor has sufficient evidence and concludes the accounts are wrong in some material way.
Examples.
Could be using the wrong accounting policy, like expensing development costs that should be capitalized under IAS 38. Could be applying a policy incorrectly, messing up depreciation calculations. Or it could be inadequate disclosure. Maybe they haven't disclosed a related party transaction properly, or the details of a major restructuring.
So, errors of commission or omission in applying the rules. The auditor is basically saying, you've got this wrong.
Correct. There's a definite difference between the auditor's conclusion and what management has presented.
Inability to obtain sufficient appropriate audit evidence. This is a scope limitation.
Yeah.
The auditor couldn't get the evidence needed to conclude whether something is misstated or not.
Why might that happen?
Could be management refusal. They won't let you talk to the lawyers or confirm receivables. Could be circumstances beyond control records destroyed in a fire, inventory located in an inaccessible war zone. Or maybe the accounting system is so flawed, you just can't trace transactions or rely on controls.
So here the auditor is saying we couldn't check.
Exactly. We lack the necessary proof. Now, once you know which problem you have, misstatement or scope limitation, the next crucial judgment is about its severity. And that hinges on the concept of pervasiveness.
Pervasiveness. This sounds like the key differentiator between, say, a minor tweak to the opinion and something really drastic. What does it mean in practice?
Pervasive is the term used when the effects of the misstatement or the potential effects of the scope limitation are not confined to specific elements or accounts, but are more widespread. ISA 705 gives 3 ways something can be pervasive. 1. It's not confined to specific elements, accounts, or items. It affects many parts of the financial statements.
Like that depreciation example you gave earlier, failing to depreciate any assets.
Exactly. That hits PPE across the board. Impacts retained earnings, distorts profit measurement significantly. It's everywhere. 2. If it is confined to one element, it represents a substantial portion of the financial statements.
For instance?
Maybe the only issue is inventory, but inventory makes up 80% of the company's total assets. A problem there is effectively a problem with the majority of the balance sheet. Great. It relates to disclosures that are fundamental to the user's understanding of the financial statements.
Like what?
Like inadequate disclosure about going concern problems, or failing to disclose the basis of preparation if it's not going concern, or maybe massive regulatory penalties that threaten the company's license to operate. Things that change the whole picture for a user.
Okay, so pervasive means it either spreads widely, hits a huge chunk, or undermines fundamental understanding. If it doesn't do any of those, it's material but not pervasive.
That's the idea. If the issue is material enough to matter, but you can isolate it like the failure to depreciate just one building out of many, or inadequate disclosure about one specific contract, then it's material but not pervasive. That distinction drives the type of opinion.
Localized versus systemic. Got it. Hashtag 3.2, the 4 opinions, matrix of modification. Right, now let's connect the dots. We have the 2 problems, misstatement, scope limit, and the 2 levels of severity, material but not pervasive, or are material and pervasive. This should give us the 4 possible opinions.
Exactly. It creates a simple matrix.
Unmodified opinion. This is the baseline. No material misstatement found, no material scope limitation encountered, or if there were issues, management fixed them. The report says the financial statements present fairly. Clean bill of health.
Okay, the ideal scenario. What if there's a problem?
Then we modify. The first level of modification is the qualified opinion. This is often called the except for opinion.
When do you issue a qualified opinion?
You issue a qualified opinion when the auditor concludes that misstatements, individually or in aggregate, are material but not pervasive to the financial statements. Or when the auditor is unable to obtain sufficient appropriate evidence, scope limitation, and concludes the possible effects could be material but not pervasive.
So it flags a specific contained problem.
Yes, the wording reflects this, if it's due to a material misstatement. In our opinion, except for the effects of the matter described in the basis for qualified opinion section, the financial statements present fairly. You explain the misstatement, for example, not providing for warranty costs, and quantify it if possible in the basis section, if it's due to a scope limitation. In our opinion, except for the possible effects of the matter described in the basis for qualified opinion section, the financial statements present fairly. You explain what you couldn't audit, e.g. couldn't observe inventory count at one location, in the basis section.
So except for this one thing or things, the rest is okay.
That's the message. Now, what if the problem is pervasive?
Then we get into the really serious opinions.
We do. If the auditor, having obtained sufficient appropriate evidence, concludes that misstatements, individually or in aggregate, are both material and pervasive, the outcome is an adverse opinion.
Adverse. That sounds bad.
It's the worst opinion you can get regarding the content of the financial statements. An adverse opinion explicitly states that the financial statements do not present fairly. It's a direct contradiction of management's assertion.
When would this happen? What's a classic example?
The most common trigger for an adverse opinion is the inappropriate use of the going concern basis. If a company is clearly collapsing, has no realistic prospect of continuing, and should be using a liquidation or breakup basis of accounting, but management insists on preparing accounts as if it's a healthy ongoing business. That misstatement affects the valuation of almost every asset and liability. It's fundamentally misleading and therefore pervasive.
So adverse material and pervasive misstatement. You know they're wrong and it's wrong everywhere.
Correct. Now, the final possibility. What if you have a scope limitation, but the potential effects are material and pervasive?
So you couldn't get the evidence, and the area you couldn't check is so big or fundamental that you just don't know if the whole set of accounts is okay.
Precisely. In this situation where the lack of evidence is pervasive, the auditor issues a disclaimer of opinion.
Disclaimer meeting.
Meaning the auditor explicitly states they do not express an opinion on the financial statements. They explain in the basis for disclaimer section why they couldn't obtain sufficient appropriate evidence. It's effectively saying, we couldn't do our job properly because of these limitations, so we cannot give you any assurance on these numbers.
Examples here.
Maybe the destruction of all the company's primary accounting records in a fire halfway through the year, or management imposing such severe restrictions, no access to key personnel, no bank confirmations allowed, no legal confirmations that you simply can't form a view on major balances. The limitation is so fundamental, an opinion is impossible.
Okay, so 4 outcomes. Unmodified, all clear, qualified material but contained issue. Adverse, material and pervasive misstatement. Disclaimer, material and pervasive lack of evidence. Mastering that matrix is key.
Absolutely key for the exam and for practice. You need to identify the issue, assess materiality, assess pervasiveness, and then select the right opinion and know how to word the report changes. Hashtag 3.3 additions that do not affect the opinion.
Now, there's another layer of complexity here, isn't there? Sometimes auditors add extra paragraphs to the report, but these paragraphs don't actually change the main opinion. They aren't qualifications. This seems like a really easy place for students to get confused.
It is a crucial distinction. These additional paragraph, emphasis of matter, other matter, material uncertainty related to going concern, are communication tools. They highlight something important for the user, but they are only used when the underlying matter has been appropriately accounted for and disclosed by management. If it wasn't disclosed properly, that would be a misstatement leading to a qualified or adverse opinion instead.
So the key is, management got the accounting and disclosure right, but the issue is so significant the auditor wants to flag it prominently.
Exactly. Let's take them one by one. First, the material uncertainty related to going concern, MURGC paragraph. This is required by ISA 570.
When is this used?
It's used when the auditor concludes that there is a material uncertainty regarding the company's ability to continue as a going concern. For example, severe losses, debt faults, loss of major customer. But management has adequately disclosed this uncertainty in the notes to the financial statements as required by ISA 1.
So management admits there's a significant risk to survival, and they've explained it in the notes. Why does the auditor need a separate paragraph then, if the disclosure is okay?
Because the potential impact of the company not continuing as a going concern is so fundamental, the auditor needs to draw specific attention to management's disclosure. The MURGC paragraph must, 1, be placed immediately after the basis for opinion section. 2, Refer explicitly to the note in the financial statements where management discusses the uncertainty. 3. State clearly that these events indicate a material uncertainty exists. 4. And crucially, state that the auditor's opinion is not modified in respect of this matter.
It's like a big signpost saying, warning, read Note X very carefully before relying on these accounts.
That's precisely its purpose. If management had failed to disclose the uncertainty, that failure itself would be a material misstatement, likely pervasive, leading straight to an adverse opinion. The MURGC paragraph is only used when the disclosure is adequate.
Okay, what about the emphasis of matter, EOM paragraph? ISA 706 covers this. How is it different?
An EOM paragraph is also used to draw attention to a matter that is appropriately presented or disclosed in the financial statements, but which, in the auditor's judgment, is so important that it's fundamental to the user's understanding of the financial statements.
Fundamental, but not a going concern uncertainty. What kind of things?
Classic examples include unusually significant subsequent events, like our factory fire example, assuming it was properly disclosed as non-adjusting, a major catastrophe that has had or continues to have a significant effect on the entity's financial position, early application of a new accounting standard that has a pervasive effect, major litigation whose outcome is uncertain but has been properly accounted for disclosed, for example, as a contingent liability disclosure.
So highlighting something already in the accounts or notes that users really shouldn't miss?
Exactly. Like the MURGC paragraph, the EOM paragraph must refer to the relevant disclosure in the financial statements and explicitly state that the auditor's opinion is not modified in respect of the matter emphasized. It's placed after the basis for opinion and typically after any MURGC paragraph if one exists.
Okay, MURGC for going concern uncertainty. EOM for other fundamental disclosed matters. What about the other matter paragraph? Also, ISA 706. Sounds similar.
Similar name, but different purpose. An other matter paragraph refers to a matter other than those presented or disclosed in the financial statements that, in the auditor's judgment, is relevant to users' understanding of the audit, the auditor's responsibilities, or the auditor's report.
Ah, so it's about the audit process or the report itself, not the content of the company's accounts.
That's the key distinction. It communicates something important that isn't found within the financial statements being audited.
Examples.
Common examples include reporting on comparative information. Maybe the prior year financials were audited by a different auditor or weren't audited at all. The other matter paragraph clarifies this. If the auditor's report is intended for specific users or purposes and distribution is restricted. If the auditor has been asked to report on more than one set of financial statements, for example, IFRS and Local J for the same company, reporting on matters relevant to the auditor's other responsibilities, perhaps under local law.
So it provides context about the audit engagement or the report itself. Where does this go?
It's typically placed after the opinion, basis for opinion, MURGC, EOM, and CAMBON sections.
Right. One more paragraph type sometimes mentioned is the other information paragraph. What's that about?
This relates to the auditor's responsibilities under ISS 720 regarding other information. Typically things like the director's report, strategic report, chairman's statement included in the annual report alongside the audited financial statements.
What's the auditor's job regarding that stuff? You don't audit it, right?
Correct. You don't audit it. But you are required to read it to identify any material inconsistencies between the other information and the audited financial statements, or inconsistencies with the knowledge you obtained during the audit.
And if you find an inconsistency, say the chairman's statement boasts about record profits, but the audited income statement shows a loss.
If there's a material inconsistency, you first discuss it with management and try to get it corrected. If the other information is wrong and management refuses to fix it, the auditor must describe the inconsistency in the other information section of the audit report. If the financial statements are wrong, you'd go back and seek to modify the opinion based on the misstatement. This paragraph basically flags unresolved conflicts between the audited numbers and the surrounding narrative.
Okay, so a lot hinges on that professional judgment. Is there a problem? Misstatement or scope limit? Is it material? Is it pervasive? Did management account for it and disclose it properly? That dictates the opinion and any extra paragraphs needed.
You've nailed it. That thought process, applying the ISA rules systematically, justifying each step, that's what mastering this final stage is all about. #tech outro.
Okay, so that was a real deep dive into the final stages of
Yeah.
review and reporting. We've covered that critical period after year-end with subsequent events, navigated the probability minefield of contingencies under IAS 37. We looked at the importance and the limitations of written representations from management, went through the detailed structure of the auditor's report, and really broke down that modification matrix, unmodified, qualified, adverse, disclaimer, based on materiality and pervasiveness.
It really is the culmination of the entire audit. All that detailed work has to be synthesized into a clear, justifiable, and standards-compliant final opinion and report. It ensures that the auditor's public statement is backed up by the evidence, by professional skepticism, and by all the relevant legal and ethical requirements.
And thinking about the whole audit process, you spend so much time planning, assessing risk, trying to reduce the risk of material misstatement.
Right, focusing on inherent risk and control risk.
But the audit report, the opinion itself, that's the ultimate expression of how well you manage the third component, detection risk. The risk that your procedures didn't catch something material.
Exactly. A clean opinion implies you believe detection risk was reduced to an acceptably low level. A modified opinion signals that either significant misstatements remain or detection risk couldn't be sufficiently reduced because of a scope limitation. The final report is the auditor's measured response to the overall audit risk assessment.
We also talked quite a bit about prudence, that built-in caution and accounting rules, especially around contingencies, recognizing liabilities early, assets late.
A cornerstone principle designed to protect users from optimistic bias.
Which leads to a final thought, maybe something for you, our listeners, to chew on as you revise this area. We see modern reporting standards like the ISAs on reporting and IFRS disclosures pushing for ever more transparency. More detailed notes, things like key audit matters, emphasis of matter paragraphs, extensive going concern disclosures.
There's definitely a trend towards more explanation, more narrative.
So here's the question. Does this heavy reliance on detailed disclosure, this push for transparency, actually end up weakening the original protective intent of prudence? Does it shift the burden? Instead of the preparer and auditor making a firm judgment based on caution, does it put the onus on the user to wade through pages of complex notes and decide for themselves what the real risks are? Has transparency started to overshadow prudence?
That's a really interesting tension in modern reporting, something worth considering as you think about the purpose and impact of these complex final stages of the audit.
Definitely food for thought. Thank you for joining us on this deep dive into the audit's final verdict.
Hope it was helpful. Until next time.